For decades, pensions were the gold standard for retirement. You worked for a company, you retired, you collected a benefit. Today, they're much more of an exception to the rule than the rule itself. Many people don't think about their pension until they're actually getting to retire, and oftentimes that's when they're making an irreversible decision that has a large impact on their life from a financial standpoint. In this episode, we're going to talk about how pensions work, why companies stopped offering them, and answering one of the biggest questions that people ask with regard to pensions is, do you take the monthly benefit or do you take the lump sum? Before we talk about how pensions work, let's first talk about why so many of them have disappeared over the years. Backing up a little bit, from a retirement plan standpoint, there are two very broad types of retirement plans. There is a defined benefit plan and there is a defined contribution plan. A defined contribution plan are what most people have in the workforce today. That's going to be your 401ks, 457s, 403bs, 401as, the company-sponsored retirement plans. The way that those work and the reason they're called a defined contribution is because you are putting funds into that plan. You are defining what contribution you are making to that plan. Whereas a defined benefit plan, there is a specific defined benefit for you, like a pension. For example, with the defined benefit plan, the company is saying, we will pay you X amount of dollars a month for the rest of your life. They're defining what that benefit is. Now, with the defined contribution plan, there's going to be an investment component to it. So you're going to put your funds in. Sometimes employers will match those contributions, and then you're going to select investment options for them. So whether or not you have money at retirement to use is going to depend on the investments in that particular plan. If you look at the defined benefit side of it, the onus is on the company itself to make sure that they're investing the funds properly to be able to provide you with that benefit. With a defined benefit plan, the employer is bearing the investment risk, whereas a defined contribution plan, the employee is bearing that investment risk. One thing you've seen overall in the industry and in the space is that the onus is switching much more to the employees to start saving as opposed to the government or their companies. You'll see this with the Secure Point 2.0 Act that came out a few years ago. It was incentivizing particularly small businesses to start retirement plans. The government and companies want individuals to start saving for retirement so that there's less of a burden on them. With the pension, the employer is going to be worrying about whether or not there's enough money. With the 401k, that's your problem. What companies were finding with pensions is that they were expensive to maintain, they were very hard to predict, and people started to live longer, which meant they were paying out those funds even longer. In general, companies want to know what their burden is going to be in the future. And with pensions, it's just a lot more difficult to predict those expenses down the road because you just don't know exactly what the landscape is going to look like, how long your employees are going to be working, how many people are contributing to the pension versus taking from the pension. In today's world, you really see pensions more so in the public sector. So governmental agencies, school systems, some companies still do offer them, but they're few and far between these days. So if you're fortunate enough to still have a pension, the next question is, how exactly is that benefit calculated? Fortunately, it's typically a relatively easy calculation. Unfortunately, every pension is a little bit different and it's not a one-size-fits-all. However, most of the time, they all use three of the same variables: your final average salary, the years that you worked for that company or the years of service, and some multiple. The multiple is the variable that you will see differentiated most among companies. Let's say, for example, your final average salary was $100,000. You worked for them for 30 years and they have a 2% multiple. That means they're going to provide you with a $60,000 benefit in the form of a pension, which would be $5,000 a month. Notice that investment returns are nowhere to be found in that calculation. Whereas with a 401k, investment returns dictate how much you'll actually have at retirement. You'll also find that pensions typically have a normal retirement age. That's the age at which you'd receive the full benefit. So in the example I provided previously, if you wait till your full retirement age, that's when you get that $60,000 a year benefit. One thing to be mindful of is that if you're collecting prior to that full retirement age, you're likely going to be taking a reduced benefit for doing so. So just because you can retire and collect your benefit doesn't necessarily mean you should. You're really going to want to understand the rules of your pension. Another thing to consider is the vesting schedule. So the vesting schedule is the amount of time that you actually need to be working for that company in order to receive the benefit. So just because you start working there doesn't mean you have the pension right away. Oftentimes, it might have a 3, 5, or even 10-year vesting period, which means in order to actually be receiving that benefit, you need to be there for a certain amount of time. I've also run into a handful of people that have had their pensions frozen. Now, just because the pension is frozen, it doesn't mean they no longer have it. Typically, what that means is there's no longer any contributions going towards it, whether employee or employer. And typically any growth that might have been associated with that pension is no longer occurring. As I've mentioned, a lot of these rules are specific to your company's pension. The area in which you can find all the answers to these questions: how is it calculated? What is the normal retirement age? What is the vesting schedule? All those answers can be found in the summary plan description for your specific plan. So I always recommend get your hands on that summary plan description and really understand how your pension works. If you work with a financial advisor, give it to them. Let them take a look at it. Because, they call it a summary plan description, but these documents can be upwards of 20, 30, 40, even 80 pages long. Accumulating the pension is only half the battle. At some point, you're going to actually have to decide what you want to do with it. What do I mean by that? Well, oftentimes with pensions, there's going to be different options for collection. I'll compare the two very broad options first, and then we can dive into the nitty gritty. First of all, oftentimes with pensions, they're going to give you the ability to either take the lump sum amount or take a monthly payment from them. Now, after you decide whether or not you want to do the lump sum or the monthly payment, you're now going to have that monthly payment option broken into several different options for you to choose from. Most of the time, the benefit calculation formula is going to determine the max single life annuity amount. That's the amount that you and you alone could receive for the entirety of your life. Typically, they'll also offer some level of survivorship option. If you're married, this can be a way in which you can keep that benefit going even after you pass. For example, you might see a 100% survivorship option, which means whatever benefit I was receiving, if I were to pass away, my spouse would receive that same benefit. Now, it's important to note, if you're going with one of the survivorship options, you're going to be receiving less than you otherwise would have if you did the max single life annuity. Because think about it from the company's perspective. They're now paying for 2 lives as opposed to just one. It's also important to note that the age of the beneficiary you name as part of that survivor option absolutely matters. The older they are, the higher the monthly benefit that you would both receive. The younger that they are, the lower the monthly benefit that you would both be receiving. And if you think about it, it makes sense. If I pick my beneficiary as someone 20 years younger than me, the odds of them living long past my passing are very high, which means that company is going to have to pay out that benefit for a longer period of time. Sometimes you'll also see period certain and pop-up options. They're much less common. You come across them a lot less. But with a period certain option, it's basically guaranteeing that benefit being paid for a certain period of time. For example, if you chose the 10-year period certain and your pension's $5,000 a month, someone is going to receive that $5,000 a month for 10 years, whether it's you or your beneficiary. With the pop-up option, what that will sometimes give you flexibility to do is, let's say you chose a survivorship option, but your spouse passes away within 5 years. They might say, okay, well, we're not going to ding you for the rest of your life on that. We'll bring you back up to what it otherwise might have been if you didn't choose a survivorship option. Lastly, you have the option to take the lump sum. Now, what the lump sum does that the monthly benefit does not is it gives you a lot more flexibility. With the monthly benefit option, you're locked into that. You're getting, in the example I was using earlier, you're getting $5,000 a month, whether you like it or not. If you need more than that, too bad. If you don't want $5,000 a month, too bad. You're getting it. Whereas with the lump sum option, you can take distributions as you see fit. I talked about the pros of the lump sum, but what about the downsides of the lump sum? Well, the investment risk has now shifted to you. You need to ensure that you're investing those funds appropriately, or else you might not have any money. Also, too, there is a risk that you outlive your money. With the monthly payment option, you're getting that monthly payment for as long as you live, whereas the lump sum, if it runs out, it runs out. Taking the lump sum doesn't make your pension disappear. It just transfers the risk from your company to you. Which brings us to the $1,000,000 question, sometimes literally, which is, how do interest rates affect your lump sum? I'll briefly touch on this. The lower that the interest rates are, and I say the interest rates, the Fed governmental mandated interest rates, the lower that they are, the higher your lump sum benefit is going to be. And vice versa. The higher interest rates are, the lower your lump sum benefit is going to be. Essentially, what they're doing when they calculate the lump sum benefit of a pension, they take a look at the current interest rate. And I'll use two extreme examples to illustrate this point. If they're paying you $60,000 a year and the interest rate is 100%, well, they only need to put $60,000 in a bucket to pay you $60,000 a year. If interest rates are 0%, for example, and they expect you to live for 20 years, well, they now have to put $1.2 million into that bucket to be able to pay you $60,000 for 20 years. In summary, higher interest rates means a lower lump sum. Lower interest rates means a higher lump sum. People often ask me, what should I do next? Should I take the lump sum or should I take the monthly benefit? And they hate the answer that I give them. And it depends. I say that jokingly because it really does depend on their specific situation. A reason that someone might go with the monthly income is that it's simple and it's guaranteed. They know they're receiving that benefit for the rest of their life and they don't have to worry about it at all. From the lump sum standpoint, people like to take that if they want to have a little bit more flexibility with those assets. Maybe they want to be able to better control the distribution. Maybe they believe they'll be able to invest in investments that outperform what their pension otherwise would have provided them. This also gives them the ability to potentially leave money to their heirs, whereas a monthly benefit option typically isn't going to allow you to do that. The only other risk that is associated with pensions that I haven't previously mentioned is that if the company goes under, your pension could go under with it. Now, there are insurances in place, and that is going to be the Pension Benefit Guarantee Committee, the PBGC. What this is any company that has a pension is going to be contributing funds towards the PBGC. What that fund is ensuring is that if a company were to go under, the pension might not necessarily go under with it. Now, with that being said, if the company goes under and the pension goes under along with it, because the pension is a liability of that company, if that does happen, the PBGC does come in, but typically you're going to be receiving a reduced benefit than you otherwise may have been entitled to if the company was still around. So there is a level of risk there too with pensions overall, but also going with that monthly benefit. What are some of the common mistakes that I see people make when it comes to pension? One, they assume that all pensions are the same. They don't take a look at their summary plan description. Two, maybe they're taking it too early and not realizing how much of a reduction they're actually taking by collecting it at 62 versus 67, for example. I've seen people ignore the lump sum when sometimes it might have been the option that best fit their needs. On the flip side of that, I've seen people discount the survivorship options because they want to go after the highest monthly benefit, and that could potentially leave their spouse in a bad financial situation if they were to pass away. A pension can be worth hundreds of thousands, if not millions of dollars during one's lifetime. That is not a decision that you want to take lightly, and you really want to understand and explore your options before making that decision, because the wrong decision can be costly. If you found this episode helpful, please make sure to like and subscribe so that you don't miss any future episodes. If you know anyone that has a pension and wants to better understand how it works, they're approaching retirement with a pension, or just want to know more, please share this episode with them if you think they'd find it helpful.